Good day, everyone, and welcome back to our Fund Managers View show. Today, we have with us Mr. Manish Sonthalia, who is the CIO at Emkay Investment Managers. Welcome, Manish sir, to the show.
Thank you.
To start with, sir, as the nation is ready to embark to the golden decade of growth, what is your outlook for the markets in the medium term, let's say 24, 25, and a little long term, say 27, 28?
So answering the long-term part is a bit easier. I think long-term everybody is bullish on India, and I think I'm also quite bullish on India because the rationale is quite simple that your economy is going to move up at least one time from where we are. So let's say $3.5 trillion to closer to around $7 trillion by 2030, and that is why we say this golden decade belongs to India. And in that backdrop, the markets are also going to move up. And I think of this long journey of 5 years, if you were to break it down between 2024 and 26, assumption is that earnings will grow by something like 17%, 18%. I think broadly markets should traject around 15% sort of growth in this interim medium term point of view. I think if you ask me the immediate near term, we are going to face elections. I think markets are range bound in that period. It's a very good time to build a portfolio in that period because post the election results, and obviously the consensus is that the ruling government is again going to come back to power, and that's the consensus. You should expect a lot of fireworks after the elections. So next 2-3 months may be a sideways movement, but after that I think the outlook is positive. I think I have said before as well that calendar 24 December, we should be closer to 24,500 on the next.
Right. That takes me to our next question. What are the key challenges that you foresee for the markets in calendar year 24 itself?
So I think rural recovery is still very weak. That is one. And I think monsoon outlook is still very unclear even now due to weather conditions like La Nina and El Nino. This was also the case the last year, and unfortunately this year also it's going to be a delayed monsoon. That is what we get to understand. That is one of the biggest factors. The second is obviously slowdown in the US. It's going to be a soft landing. We are going to face recessionary conditions. The demand environment from, let's say, previous year to this year will be a tad weaker on the export side. So we got to be watchful of how our exports are likely to grow because there are a lot of challenges. First, the demand is weak. Second, you have the Red Sea issue where your freight costs have gone up and something to the tune of 700%. Where is the demand that you can absorb so much of an increase in cost? So I think export remains one of the biggest challenges. You have erratic monsoon and rural recovery. That's still lingering on the horizon. And third, obviously, is the rate cut delay. Obviously, previously, the assumption was that March, US is likely to see a rate cut and we'll actually see a rate cut after a hiatus. But it doesn't look like that March we are going to see a US rate cut. It'll probably be July or even after that. But I think a delay in the rate cuts would mean a prolonged rate cut cycle even for India. That is, not so much of a risk, but yeah, there is some degree of uncertainty out there. Apart from that, I really don't think, oil poses a major issue because there is ample supply of oil and energy costs are likely to be under check. And India is firing on all cylinders. We just hope that the continuity of the government happens post the elections and we should be fine, I would believe so.
Investors generally get restless about the quantum of their returns in growth cycles. What would you advise to those investors?
So look at equity investments as investments and not a casino sort of a thing, because this is one long journey. It's not a short sprint, and investing is generally very boring, and then only you make money. If you want too much of excitement, you should not be out here, you should be in some casino. So having said that, I think 15 to 20% sort of a return is what we would endeavor to achieve. across cycles. And the maths is very simple, is that earnings and market caps emulate each other. They move in tandem. The market cap and the earnings, may differ in time periods only by that much. But otherwise, if you are happening to buy sectors or stocks or themes or the portfolio as a whole, not very expensive, then broadly the earnings growth would project into your market capital. So we want to buy companies which can double their profits in 3 to 4 years. So ideally, your portfolio should double in 3 to 4 years. We keep some margin of safety. That is why we are saying 15 to 20% should be expected rate of return. And that is what we endeavor to achieve. If the markets are doing more than that, we always have an obligation to do better than the market. That is to generate an alpha at all points in time. So if markets were to fall, we should fall less than the market. That always is there at the back of your head. But we are not going to buy speculative sectors or too cyclical sectors, and we really don't think that we really have the competencies to deal with global cyclicals and so on and so forth. So I think we are competent enough to bet on themes structural in the context of India, and in that, on a bottom-up approach basis, buying good businesses, good management, which can double their profits in 3 to 4 years, ideally, and not overpay for it. That's probably how we go about it.
Sir, in your interview with NDTV recently, you had indicated that small and mid caps could rally as much as 15% in 24. But with the markets poised towards the sideways this year, where do you see the pockets of growth for investments?
So first of all, I don't think the markets are going to be sideways this year. Markets are going to be up this year. And in the context of what I said in the television interview, was that if markets were to move up 15% this year, then it is very unlikely. And because when we refer to the market, we refer to the large cap, that is the Nifty 50 or BSE Sensex, and these constitute primarily of large caps only. So if the large cap were to move up 15%, it is very unlikely, given the broad-based recovery and the broad-based growth in the economy, that you will have the mid and small caps actually move less than the large caps. So I said 15% in that context. And obviously we are at 22,000 on the Nifty. The markets are already up some 10-12% from March levels, or March 23 levels, and I think by the end of this calendar we should be closer to 24.5. And markets won't be very expensive because earnings growth is projecting well. So I think in the mid cap and small cap, it's not about the index per se, but what you pick and choose. It's going to be a stock pickers market as well as the mid. The opportunities are galore, but it's very unlikely that mid and small caps are likely to underperform large caps. I really don't think.
Also, sir, you have been managing the newly launched Emkay Emerging Stars Fund Series 6. Can you share a quick overview on the same, or how has the fund been doing so far?
Yeah, so I think India's golden decade of growth hinges on 5 themes, which we think is going to do much better than the rest of the growth sectors as far as India is concerned between now and 2030. And I think the 5 themes are consumption, which is an evergreen theme in the context of India. If you're talking about $7 trillion economy, per capita income is obviously going to grow, and more discretionary consumption will happen as opposed to staples consumption, and that is the big theme in the context of India. The second is obviously financialization of savings, and we know that bulk of India saves in fixed deposits, but not everybody is happy with post-tax returns on fixed deposits or fixed income when your inflation is running at 5% on the CPI. And so there is a move, since the economy is growing, to move away from fixed income sort of a savings as a percentage of a financial savings to equities as a percentage of your financial savings. And this growth, which started during the pandemic, is continuing. And thanks to financial literacy, equity cult, as far as India is concerned, is on the move. So everything to do with capital markets, and particularly the equity side of capital markets, and if those businesses are particularly platformized, that will give you non-linear growth opportunities. The third is obviously India's manufacturing prowess. The whole world knows it. China The world wants to diversify away in terms of supply chain, and India poses a next best alternative. One of the next best alternatives. It depends on us how we are going to capitalize these opportunities. A lot of work is happening out here in many sectors. Latest one being electronics, specialty chemicals was always there during the pandemic itself. Pharma and IT, we have established a place in the world as far as exports are concerned. Autocoms again is an emerging sector where we will supply auto parts to the rest of the world. So I think manufacturing is particularly relevant because government is providing incentives in the form of PLI to set up units and export out of the country, and you get incentives, or let's say the leverage on India's balance sheet is very low. Industrials and private capex was elusive, but now since government is embarked on a huge round of government capex, a multiplier effect in terms of private capex will also come through, because industry's ROC is gone up, balance sheets are very deleveraged, and working capital has got shrunk. So overall cash conversion cycle has improved significantly. And if we get an impetus on growth, thanks to a real GDP growth of 6% plus over the next 5 years, obviously we need capacity. And manufacturing will stand out as one of the major beneficiaries, because we have predominantly been an exports driven economy, and now is the time that we need to shift a little bit of our growth away from exports. That is not to say exports are not important, but exports, apart from exports, manufacturing, that will give a big boost to the manufacturing side of things. So that being the third theme. The fourth is our green energy transition, and it's now upon us, and each segment of this entire value chain is likely to see extraordinary growth. The challenge is not about the thematic growth, the challenge is to find individual names, because the whole world now believes that this theme is likely to stay, and everything is prohibitively expensive. The markets seem to be discounting FY26 numbers, 27 numbers, 28 numbers. So the entire theme is going to do well, but the whole theme is you have to buy individual stocks rather than the theme itself. So this is the next big theme. And the fifth is artificial intelligence and digitization. Again, you have been reading in media about the amount that is getting spent on AI and the opportunities that are likely to come to India in the next 5 years. So India is not going to be inventing the technology, that's prerogative of China and US, but we are going to likely make applications around it. And again, the challenge is to find individual companies. But this sector and this theme is likely to make huge amounts of money. So we are predominantly focusing on these 5 themes. I think we launched the fund officially on 1st of October 2023. Our first closing was towards the end of November. So I think the fund is already having a NAV of closer to 113. So already 13% sort of returns are there. And the markets are broadly in those, and we are lining up our investments and deploying the full capital, so to speak. So fund is up absolute terms around 13%, and it's just about 2-3 months now. So that's basically the overview of the fund. I think there's a lot of excitement about the fund, and generally people are of the view, and this is a consensus opinion, that broadly these 5 things should be doing better than the others in the next 5 years or so. So that's basically my feedback.
Wow, great. I think that was rather insightful in terms of the ongoing Emkay Emerging Stars Fund, as well as sir gave us a lot of gyan on the current sectors that are looking bullish. But today I'm going to do something different, and let's move to a fun segment, sir. I am going to give you 5 seconds. Tell me the first thing that comes to your mind when I say the following.
Okay.
Specialty chemicals.
Pitava sector, but viable.
BFSI, NBFCs.
Ignorable. Bad times.
Cement.
Near-term growth is good.
Retail.
Huge opportunity. Big wealth creator for the next 5 years.
Auto and auto ancillaries.
I think bulk of the growth has already played out. It's going to be a challenging year as far as growth is concerned from the previous year's point of view, if you were to compare on a YY basis. Auto Ang should be doing better than autos.
BFSI banks,
Public sector,
telecommunication,
ignorable. It's just there or not there doesn't make a difference.
information technology,
Big bullish stance this year.
logistics,
Huge opportunity.
oil and gas,
Huge opportunity. I think given the valuations.
consumer goods,
So you've got to think medium term. As I said that inflation is hitting the pockets of consumers. I think give it a 2 quarters and the sector will come roaring back. So you should buy at least from a 2 quarters point of view.
okay, building materials,
Again, I think this is one of the sectors which will do very well from the next 3 to 5 year point of view. And today you have the opportunity in terms of very good valuations. So, I mean, genuine investments if you do in this space will likely make a lot of money.
hotels,
I think cyclical peak. It's just too frothy given the valuation. I don't know how people are going to make money at these sort of valuation. I believe this was a sector to be bought during the pandemic when there was no growth. And now everything is growth, but the percentage growth is going to come down. And that's not there in the valuations. I think it's still going to move up, but the percentage growth is going to come off when you compare it to the previous year. Ignorable.
okay, BFSI other than banks and NBFCs,
Platformized businesses are likely to do very well. So there's going to be a non-linearity, whether it be exchanges, depositories, wealth management platforms, AMCs, broking, fintechs. They are likely to do very well.
media and entertainment,
Ignorable. I mean, it doesn't really move the needle at all.
and last but not the least, healthcare,
Huge opportunity in pharma, particularly in generic exports as well as domestic pharma, because valuations are very good. As far as the hospital segment is concerned, it's the same as hotels. We are at a cyclical peak. You can't have hospitals trading at FMCG valuations. Just not doable. I think fraught with danger to buy hospitals at current levels.
Great. Thank you so much, sir. That was a quick overview on all the sectors. Thank you, viewers, for watching, and don't forget to subscribe.